In the charts, Cora, can you tell me what's going to happen?
We're going to try to figure that out.
You really?
Maybe we go over and look at a few.
You're going to get up and do that.
You sending him over?
How about
that? Is he being banished to the board right now?
I had no idea.
Is it this early in the show?
You can do that? You can do that?
He's up now.
Here we go.
No stopping Quick ever done this on Squawk. No stopping.
No. We go to the chair.
Here's the last 2 years. Apple, no drawings, no lines, no judgments by me. And what we do know, of course, is that Apple has a fairly major break in trend. So taking a look at this chart with the trend line drawn, what you'll see is, well, I'll draw it here myself. Take a look. We have a well-defined trend. Literally, we've connected these lows, and we have broken from these well-defined lows. But at this point, having been so precise for so long, we're so far below that I think we kick back here a bit, right? And that we actually throw back towards trend, which is often the case. Further, there's a lot of support right here where we've sold off. So the idea here is at this point, there's the trend line, there's the break, and so after plunging, you can typically get a throwback. The throwback doesn't fix the situation per se. It's a trade more than saying Apple's out of the woods and all-time highs coming, because I think those highs will stand for a long time. But you'd rather be long here, I think, than short. Let's look at a few things that are important. So this is over the past decade, the past bull market. We've had big drawdowns, right? We drew down 45%. We drew down 33, and this is now 30. And here's the interesting thing. This bottom chart is relative performance to the S&P. Actually, relative performance peaked back in 11, 12, and Apple has not been such a good performer. What we do know, though, is this, that it has responded precisely over and over and over off this relative line. And I think that's exactly what we're setting up for here, and that actually Apple is a better bet than the market overall. Let's look at the market and a few things about that. It's been a really bad year. I mean, it feels like unch, but it's not unch. Forget all these things. Look at this. The Russell 3000, 98% of the investable capital. We are down. The median stock is down 9%. That's the true story of the market. And what we know is at this point that there's every possibility, frankly, that Apple is a better bet than the S&P. In terms of the sub-industry groups, take a look at the numbers, look at the ratio, numbers up versus down within the S&P. And so it does get down to the question whether at this point you want to make up this volatility. This does not make people want to come into the market. When you go down 8% and then rally, and then down 7%, then rally, then down 8%. The problem with this is this kind of volatility doesn't induce people to buy stocks. It makes them want to back away from stocks. So if I put in the up moves, there they are, next chart. And this basic circumstance is what I would characterize as spasms, ultimately, that resolve in lower prices. I'd rather do Apple here than the market. This is the kind of thing that makes money want to get out, not in.
But can he come?
Well, no,
can he come back to the desk?
May I ask him a question?
Well, yeah, but we're going to invite him back.
No, I like it when he's there. Then maybe
then let him do it over there.
Hey, big fan of your work, as you know, Carter. Now, the trend line that Apple broke to the downside, what does it need? What does Apple, the stock, need to recapture? Understanding that over time, the level that it needs to recapture gets higher and higher. But where does it need to recapture to break out back towards the upside?
You've got to get back at least 10%. It would be back to these tops from which it broke out. So you have the well-defined tops, yes. You have, that's also the trend line. You have this breakout, and then this undershoot of the line, you should, in principle, make it back to level. So that's about 6 to 8% from where we are today's close.
Beautiful.
All right, so come back. So, Carter, you saw you played right into that lead story in the Wall Street Journal today. You saw it, I guess, right? Lead story in the Wall Street Journal was nobody's buying the dips because that would explain it. But, I mean, that looked like a good pattern until we broke the lows, didn't it?
You mean the back and filling?
Yeah.
Well, the problem with that is it's that occurs after the October plunge. So it's the worst October in a decade. And then there's an adage, sharp indecision is resolved sharply. There's a big debate going on. Is this something to take advantage of, or is it weakness to stay away from? In principle, after a drop like that and a break of a multi-year trend, it's not the buy the dip, it's the something's changed and you should de-risk.
And something has very much changed. And again, I would look today to two things that are somewhat somewhat conflicting. You had the SMH, so you had the semis, which to me led all of this down in the middle of the summer. And actually, semis, before the market actually rallied back, semis actually were up. And semis, on this zigzag that Carter's been pointing out, semis have been making slightly higher lows. I would also argue that the 10-year bond ultimately around 280 to 285, if we don't hold that level, it's a very scary time for markets. But there's nothing that happened today, and we're not going to resolve, I think this is what Carter's saying, we're not going to resolve the last 3 months of pain and volatility, and that's 6 moves of roughly 6 to 7 to 8% up and down. Doesn't make anybody feel terribly good. So today's a nice day for people that thought we were going to break. We've tested 2,600 6 times on the S&P. Why do we need to stop testing? I think we need to keep testing.
You need to test the February lows at 25.32, and let's see if that holds. And today was a pretty good attempt at doing it. I thought we were going to do it today, actually, but they never forced them down.
Right, which means we never are getting capitulation. Every time you come down, there's someone stepping in. You really want it to be to the point where people don't want to buy, and there's still an appetite for buying.
And that's what keeps stealing the heart of the market, because you're playing around with 200 handles in the S&P from 2,600 to 2,800, sucks everyone back in, and then takes it right out. So I don't see a lot of volume behind these moves. So people that have been beaten up aren't playing the market. People that are sitting on a profit aren't playing the market. So we're sort of in no man's land right now until the market has that definition.
I think that's right.
So it's not technical. Let's bring it back just to talk about secular and cyclical and all these things. So are we still in a secular bull? We're diddling around with the correction. Are we diddling around with the correction still to get a real correction?
Every single country had a PMI over 50. The last time that happened was 2007.
Okay.
So 2007 was a market peak. This beginning of the year was a market peak, and we've never gotten over that. We've been struggling with the blow off top. That January move was the highest weekly RSI reading ever recorded in the S&P going back to 1927. With record inflows into ETFs and the spiders and iShares. That kind of excess isn't worked off easily, and we're still, almost a year later, contending.
Although we had a record 9-day RSI on the S&P probably 6 weeks ago that we hadn't seen since the worst of the crisis. So
right, but that's the crisis versus the overbought was the worst since 1927. The crisis is only 10 years ago. That's getting to be 80 years ago.
So talking about the PMIs and talking about, look, the reality of the fundamentals is Europe continues to get worse. We had Eurozone confidence, which is the weakest since December 2014. You've got these yellow vest protests in France that continue to get worse. The Italian budget's just a couple headlines away from being a very big deal. You've got ECB out on Thursday, and they're talking about stopping buying at the end of this month. Is that economy really ready for that? So if you ask me if the global economy is getting better, you had terrible export data out of China over the weekend, or trade data. No, it's not. It's actually getting significantly worse. And that's something that this market was not paying attention to for a long time and now is, and I think that's appropriate.
European banks still a concern. I mean, even with the news over the weekend about Deutsche Bank, Commerzbank, still stocks down 4%, continues to make new lows. The Russell continues to make lower highs and lower lows. And I can't figure out, for the life of me, who has the better head of hair. You, who looks like Barry Melrose today for whatever reason, or Joe Kernen, who always has a great head.
That's why they sat us together.
You're doing it naturally, though, aren't you?
I'm out. I'm not even in this game.
I put this wig on.
No. I mean, you haven't, do with the Propecia. I mean, Propecia. You don't know what? Honestly?
I do, but no thanks.
Oh, you don't want to talk about it?
No, I don't have any.
Don't be embarrassed.
Don't want any.
Don't be embarrassed. I mean,
split screen, though, is there, which is impressive.